If being smart were enough to be a profitable trader, every engineer, doctor, and PhD would be rich. They're not. Here's why. Think about the smartest people you know. The engineers who can solve complex equations, the doctors who memorize thousands of pages of medical knowledge, the programmers who can code in 5 languages. How many of them are successful traders? Probably none. And here's what's interesting. It's not because trading is more intellectually difficult than engineering or medicine. It's not because they can't understand charts or calculate risk-reward ratios. They understand these concepts just fine. They fail because trading isn't an intelligence test. It's an emotional discipline test. There's a quote that perfectly captures this. The key to trading success is emotional discipline. If intelligence were the key, there would be a lot more people making money trading. Let that sink in. Intelligence is not the bottleneck. Emotional control is. In the next few minutes, I'm going to show you exactly why smart people consistently fail at trading, while people with average intelligence but superior emotional discipline succeed. I'm going to give you real examples that will make this crystal clear. And most importantly, I'm going to show you what emotional discipline actually looks like in practice, not in theory. Because here's the truth. You probably already understand trading intellectually. What you lack is the ability to control your emotions when money is on the line. The intelligence trap. Let me tell you a story that perfectly illustrates this. A friend of mine is a software engineer at a major tech company. This guy is brilliant. He has a master's degree in computer science from a top university. He makes 6 figures. He can explain complex algorithms that would make most people's heads spin. He got interested in trading about 3 years ago, and he approached it exactly like you'd expect a smart person to approach anything, intellectually. He spent 6 months studying. He read every classic trading book. He learned technical analysis, fundamental analysis, option strategies, and risk management formulas. He built spreadsheets to calculate position sizes. He even coded his own back-testing software to test strategies on historical data. This guy did everything right from an intellectual standpoint. Then he started trading with real money, and within 4 months, he had lost 30% of his account. What happened? It wasn't that his strategies didn't work. His backtests were solid. His risk management formulas were correct. His understanding of the market was good. What happened was emotional sabotage. Here's a real example from his trading. David had a rule that he would never risk more than 1% of his account on any single trade. Smart rule, good risk management. He took a trade on a stock that looked perfect. His analysis was thorough. His entry was good. He set his stop loss exactly where it should be, risking exactly 1% of his account. The trade went against him immediately. The stock dropped and hit his stop loss. He lost 1% exactly as planned. This is what's supposed to happen. You take the loss and move on. But he was frustrated. He had spent hours analyzing this trade. He was sure it would work. So his brain started rationalizing. The market is just being irrational right now. My analysis was correct. If I had just given it more room, it would have worked. So what did he do? He entered the same trade again. But this time, he doubled his position size and widened his stop loss. Why? Because emotionally, he needed to be right. He needed to prove his analysis was correct. His intelligence was being challenged, and his ego couldn't accept being wrong. That second trade also lost, but this time, because he doubled his size and widened his stop, he lost 4% instead of 1%. In 2 trades on the same stock, he lost 5% of his account because he couldn't emotionally accept being wrong the first time. Now, here's the important part. He knew this was wrong while he was doing it. His brain was screaming at him. This is revenge trading. This violates your rules. Don't do this. But his emotions were stronger than his knowledge. This is the intelligence trap. Smart people understand the concepts. They know what they should do. But when emotions take over, when ego, fear, greed, or frustration kick in, intelligence becomes irrelevant. A less intelligent person who can follow their rules mechanically will outperform a genius who can't control their emotional responses. So, what is emotional discipline in trading? Let me break it down with concrete examples. Example 1. Taking losses without hesitation. Imagine you're in a trade. You bought a stock at $50 with a stop loss at $49. The stock drops to $49. Emotional discipline means you exit immediately at $49 without question. No hoping it comes back. No moving your stop loss lower. No, just give it a few more minutes. Most traders can't do this. Their brain starts negotiating. It's just temporary weakness. It'll bounce back. I just need to be patient. If I take this loss, I'll feel stupid. So they hold. The stock drops to 48, then 47, then 45. Now they're down 10% instead of 2%. And they still don't want to sell because the loss feels too big to accept. A trader with emotional discipline doesn't have this internal debate. The stock hits $49. They exit. Done. They might feel disappointed, but they execute without hesitation. Example 2. Not revenge trading. Here's another common scenario. You take 3 trades in a row and all 3 lose money. You're down $600 for the day. Now, you see another setup, but if you're honest with yourself, this one is marginal. It's not your best setup. It doesn't quite meet all your criteria. A trader without emotional discipline takes this trade anyway. Why? Because they're trying to get back the money they lost. They're trading their emotions, not their strategy. A trader with emotional discipline looks at this marginal setup and says, "This doesn't meet my criteria. I'm not taking it." Even though they're down money, even though they want to make it back, even though sitting on their hands feels painful. Example 3. Cutting winners short. You enter a trade at $50. Your target is $55. Based on your analysis, the stock moves to $52. Now you're up $2 per share. Your brain starts saying, "This is nice profit. Maybe I should lock it in. What if it reverses and I lose this profit? A bird in the hand is worth 2 in the bush." So you sell at $52, feeling good about your $2 profit. Then the stock continues to $55, then $50. You missed out on the full move because fear of losing your profit overcame your plan. A trader with emotional discipline stays in a trade until their target or their trailing stop is hit. They don't make emotional exit decisions based on fear. Example 4. Overtrading from boredom. It's 2 p.m. You've been watching the market for 5 hours. Your strategy has only given you one valid signal all day, which you took. Now you're bored. You're sitting there watching stocks move and you feel like you should be doing something. You're not working if you're not trading, right? So you start looking for setups that aren't really there. You convince yourself that marginal signals are actually good enough. You take trades just to have action. A trader with emotional discipline can sit and watch for hours without trading if there are no valid setups. They understand that waiting is part of the job. They can tolerate boredom without acting on it. See the pattern here? Emotional discipline isn't about understanding what to do. It's about doing it even when your emotions are screaming at you to do something else. Intelligence helps you understand that you should cut losses quickly. Emotional discipline makes you actually do it. Intelligence helps you understand that revenge trading is bad. Emotional discipline prevents you from doing it anyway. Here's something counterintuitive. Being smart can actually make emotional discipline harder in trading. Why? 3 reasons. Reason 1. Smart people are used to being right. If you've been successful in school or your career, you've been rewarded for being right. You study hard. You get good grades. You solve problems correctly. You get promoted. Your intelligence has been an advantage your entire life. Then, you come to trading, and suddenly being right doesn't matter as much as you think. You can analyze a trade perfectly, enter at the right time, and still lose money because the market did something unexpected. The market doesn't care about your analysis. It doesn't reward you for being smart. This is psychologically devastating for intelligent people. Their ego is tied to being right. So when trades lose, they take it personally. They can't accept that sometimes you do everything correctly and still lose. This leads to 2 problems. First, they keep trying to be more right by doing more analysis, adding more indicators, and studying more. But trading isn't about being right more often. It's about managing risk and executing consistently. Second, they can't admit when they're wrong because it feels like a failure of their intelligence. So they hold losing trades, hoping to be proven right eventually. Reason 2. Smart people overthink. Intelligent people are good at analyzing complex problems and seeing multiple angles. This is usually an advantage, but in trading, overthinking kills execution. Let me give you an example. Your strategy gives you a buy signal. It's a clear signal that meets all your criteria. A trader without emotional discipline but with average intelligence sees the signal and takes the trade. Simple. A smart trader sees the same signal and starts thinking. But wait, the broader market looks weak today. This worked last time, but market conditions are slightly different now. Let me check one more indicator to be sure. What if this is a false signal? They analyze themselves into paralysis. By the time they decide to take the trade, they've missed the entry, or they don't take it at all because they talk themselves out of it. Then the trade works perfectly without them. This happens because smart people aren't comfortable following mechanical rules. They want to understand and evaluate each situation. They trust their intelligence more than their system. But successful trading often requires turning your brain off and just executing your rules mechanically. Reason 3. Smart people think they can outsmart the market. Here's the big one. Intelligent people believe that if they just think hard enough and analyze deeply enough, they can figure out what the market will do. So they look for patterns, they develop theories, they try to predict, and sometimes they're right. This gives them confidence that their intelligence is giving them an edge. But here's the problem. The market is probabilistic, not deterministic. You can't outsmart probability. You can't think your way to certainty. A trader with emotional discipline accepts that they don't know what will happen next. They don't try to predict. They just execute their system, manage risk, and let probability play out over many trades. A smart trader struggles with this because accepting uncertainty feels like giving up. It feels like they're not using their intelligence. So they keep trying to predict, which leads to overconfidence in trades that feel certain. Let me give you a real example. I know a trader, formerly a finance professor with a PhD, who blew up his account 3 times. Same pattern every time. He developed a sophisticated model for predicting market moves. The model would work for a while. He'd become convinced his intelligence had cracked the code. He'd start sizing up his positions because he was sure his model was right. Then the market would change. His model would stop working. But instead of accepting this and cutting his losses, he'd hold positions because his model said they should work. He couldn't accept that his intelligent analysis could be wrong. Each time, he lost everything because his intelligence made him overconfident and his ego prevented him from admitting uncertainty. The paradox of simple strategies. Here's something that proves intelligence isn't the key. The most profitable traders often use incredibly simple strategies. Let me tell you about a trader I know named Mike. Mike has a high school education. He works in construction. He's not dumb, but he's not intellectual. He'd never describe himself as smart. Mike's trading strategy is ridiculously simple. He trades one setup, a specific candlestick pattern at support levels. That's it. No complex indicators, no elaborate analysis, just one pattern he learned from a book. His rules are: wait for his specific pattern at support. Enter with a tight stop loss. Target is 2x his risk. Never risk more than 1% per trade. Maximum 3 trades per day. Mike makes about $60,000 per year from trading on top of his construction income. Not enough to quit his job, but substantial extra income. Now, many smart traders look at Mike's strategy and think it's too simple. They think that can't work consistently. It's not sophisticated enough. But here's why Mike succeeds: emotional discipline. Mike doesn't care about understanding why his pattern works. He doesn't theorize about market psychology. He doesn't try to improve it by adding indicators. He just follows his rules robotically. When his pattern appears, he takes the trade every time. No hesitation. When his stop loss is hit, he exits immediately. Every time. No hoping or holding. When he's taken 3 trades, he stops for the day. Even if he sees more setups. Even if he's down money and wants to make it back. Mike has emotional discipline. Not because he's extraordinarily disciplined by nature, but because his simple system doesn't require much thinking. There's nothing to overthink. The rules are clear, so execution is straightforward. Compare this to David, my engineer friend from earlier. David's strategy was more sophisticated. He used multiple time frames, several indicators, fundamental analysis for stock selection, and complex position sizing formulas. His strategy might have been better intellectually, but it required so many decisions and so much analysis that emotional discipline became nearly impossible to maintain. There were too many opportunities for his emotions to interfere. This is the paradox. Simple strategies executed with discipline often outperform complex strategies executed inconsistently. Why? Because the complexity isn't in the strategy, it's in the execution. The hard part isn't figuring out what to do. The hard part is doing it consistently when you're scared, when you're greedy, when you're bored, when you're frustrated. A simple strategy minimizes the decisions you need to make, which minimizes the opportunities for emotional interference. Let me give you some more concrete examples of how emotional discipline shows up in real trading situations. Situation 1. The winning streak. You've taken 5 trades in a row, and all 5 won. You're up $2,000 for the week. You're feeling confident. Actually, you're feeling invincible. Your 6th setup appears. Your system says risk 1% as usual, but your emotions say you're on a hot streak. You clearly understand the market right now. Why not size up to 3% on this trade and really capitalize on this momentum? Without emotional discipline, you size up. You're trading your emotions, specifically overconfidence, not your system. Then the trade loses, but because you sized up, you lose 3% instead of 1%. That one loss gives back a large chunk of your weekly gains. With emotional discipline, you risk the same 1% you always risk. The winning streak doesn't matter. You don't trade differently because you're confident. You just execute your system. Situation 2. The losing streak. Opposite scenario. You've lost 4 trades in a row. You're down $800. Your confidence is shaken. you're starting to doubt your strategy. Your fifth setup appears. It's a perfect setup by your criteria. Without emotional discipline, you either A, skip the trade because you're scared it will lose, or B, size down to 0.5% because you don't trust your system right now. Then the trade wins. But if you skipped it, you missed the winner that would have started your recovery. If you sized down, you only made $100 instead of $200. With emotional discipline, you take the trade at your normal 1% risk. Your confidence level doesn't change your execution. Losing streaks are normal variance. You execute through them. Situation 3. The big news day. There's a major economic report coming out in 30 minutes. The market is quiet, waiting for the news. Your strategy has given you a signal to enter a trade right now. Your emotions say, wait until after the news. It's too risky to enter before a big announcement. What if the news causes a big move against you? This sounds reasonable, but here's the thing. If your strategy didn't account for news events and your system gave you a signal, then taking the trade is following your plan. Without emotional discipline, you skip the trade to avoid the fear of news-related volatility. With emotional discipline, you ask yourself, does my system have a rule about news events? If yes, follow it. If no, take the trade. Your feelings about the news don't override your system. Situation 4. The slow day. It's been 3 hours and you've seen 0 valid setups. The market is choppy and directionless. You're bored and frustrated. You see a stock making a move. It doesn't meet your criteria, but it's moving, and you're tempted. Your emotions say you're wasting time doing nothing. At least try to catch some of this move. Without emotional discipline, you take a low-quality trade just to have action. Most of these trades lose because they weren't actually good setups. With emotional discipline, you keep watching without trading. You accept that some days have no valid setups. Waiting is your job on those days. Situation 5. The mistrade. You got distracted and missed taking a trade that your system signaled. You watch it move without you. It would have been a $500 winner. Now you're frustrated and angry at yourself. Another setup appears 20 minutes later. Without emotional discipline, you take this second trade, even though it's not quite as good as your usual criteria. You're trying to make up for missing the first one. This is emotionally driven trading. With emotional discipline, you evaluate the second setup objectively. Does it meet your criteria or not? The fact that you missed a previous trade is irrelevant. You don't try to catch up to where you would have been. Notice in all these situations, the emotionally disciplined response isn't smarter or more complex. It's actually simpler. Just follow your rules regardless of how you feel. So, how do you actually develop emotional discipline? Because knowing you need it and having it are completely different things. Here are practical strategies that actually work. Strategy number 1, trade small. The fastest way to build patience is to trade smaller than feels necessary. If you're risking 1% per trade, cut it to 0.5%. If losses still bother you, go smaller. Here's why this works. When your position size triggers anxiety, your brain enters fight or flight mode. You literally cannot be patient when you're stressed. You'll cut winners early, hold losers hoping they come back, and take impulsive revenge trades. But when you trade small enough that losses barely register emotionally, everything changes. You hold winners longer because profit doesn't feel precious. You take losses without hesitation because they don't hurt. You wait for quality setups because you're not desperate to make money. Trading small isn't about making less money. It's about building the emotional stability that allows you to execute your plan consistently. Strategy number 2, create a pre-trade checklist. Impatient trades happen because you see a setup and immediately feel FOMO or excitement. Your emotional brain takes over and you enter before thinking clearly. A pre-trade checklist forces a pause. Before entering any trade, you must verify. Does this meet all my criteria? Where's my entry? Where's my stop loss? What's my position size? Am I trading my plan or my emotions? This takes 30 seconds, but those 30 seconds engage a rational brain and kill impulsive decisions. If you can't honestly check every box, you don't take the trade. Simple as that. The checklist doesn't just prevent bad trades, it trains your brain to slow down and think before acting. Over time, patience becomes a habit. Strategy number 3. Limit how often you check charts. If you're checking your trades every 5 minutes, you're training impatience. Every time you look, you're giving your emotions another chance to override your plan. Here's the rule. Once you enter a trade and set your stop and target, close your platform, set a price alert, and go do something else. Only check back when your alert triggers or at scheduled times, maybe once in the morning and once in the afternoon. This feels uncomfortable at first because you're addicted to the stimulation of watching price move, but constant monitoring destroys patience. You start seeing patterns that aren't there. You second-guess your plan. You make emotional exit decisions. When you limit screen time, you force patience because you're literally not giving yourself the opportunity to be impulsive. Strategy number 4. End-of-day review, not real-time analysis. Most traders obsess over their trades in real time. They analyze every tick, second-guess every decision, and mentally torture themselves while positions are open. This destroys patience because you're constantly in an emotional state. Instead, do all your analysis after the market closes. During trading hours, you execute. After trading hours, you analyze and journal. This separation is critical. When you review trades at the end of the day, emotions have settled. You can think objectively about what worked and what didn't. You can plan tomorrow's trades calmly instead of making reactive decisions in the heat of the moment. Real-time analysis feels productive, but it's usually just emotional interference disguised as work. Strategy number 5. Reduce position size after 2 losses. Here's a rule that will save you from tilt. After 2 losing trades in a row, cut your position size in half for your next trade. Why? Because losing streaks trigger emotional responses that kill patience. After 2 losses, you're either scared and likely to skip good setups, angry and likely to revenge trade, or desperate to make it back. All of these emotions lead to impatient bad decisions. By forcing yourself to trade smaller, you remove the emotional stakes. You can't make or lose significant money, so you relax. This allows you to trade your plan instead of your emotions. Once you've taken 3 trades with reduced size and proven you can execute calmly, you return to normal size. This rule prevents tilt before it destroys your account. Now, let me tell you something you need to hear. Even though it's uncomfortable, if you're struggling with emotional discipline, it's not because you haven't found the right technique yet. It's not because you need to read more books or watch more videos about trading psychology. It's because you haven't accepted what trading actually requires. Trading requires you to be comfortable with uncertainty. Most people can't do this. They need to feel in control. Trading requires you to accept losses as part of the process. Most people take losses personally and see them as failures. Trading requires you to be patient and do nothing most of the time. Most people equate activity with productivity. Trading requires you to follow rules even when they feel wrong. Most people trust their intuition more than their system. Trading requires you to treat money unemotionally. Most people have deep emotional attachments to money. It represents security, status, self-worth. If you can't do these things, no amount of intelligence will make you successful. You can have a PhD in mathematics and still blow up your account if you lack emotional discipline. And here's what's hard to accept. Some people will never develop sufficient emotional discipline for trading, not because they're weak or flawed, but because trading psychology conflicts too much with their natural personality. If you need to be right to feel good about yourself, trading will torture you because you'll be wrong frequently. If you need to understand exactly why everything happens, trading will frustrate you because markets are often irrational in the short term. If you need constant action and stimulation, trading will bore you during the waiting periods, leading you to overtrade. This doesn't mean you're not capable of success in other areas. It just means trading might not be the right fit for your psychology. And that's okay. Not every skill set fits every person. But if you're willing to work on emotional discipline, if you can accept uncertainty, follow rules mechanically, take losses without self-judgment, and wait patiently for good setups, then you can succeed at trading regardless of your intelligence level. Let's bring this full circle. The key to trading success is emotional discipline. If intelligence were the key, there would be a lot more people making money trading. This is true because intelligence helps you understand what to do. Emotional discipline makes you actually do it. Intelligence helps you analyze markets. Emotional discipline makes you execute your analysis consistently. Intelligence helps you create good strategies. Emotional discipline makes you stick to those strategies during inevitable losing streaks. Think about my two examples, David the engineer and Mike the construction worker. David is objectively more intelligent. He has more education, more analytical ability, and a more sophisticated understanding of markets. But he lacks emotional discipline, so he loses money. Mike has average intelligence and a simple strategy, but he has emotional discipline, so he makes money consistently. The market doesn't reward intelligence, it rewards consistent execution. Here's what this means for you practically. Stop looking for smarter strategies. Stop thinking that more education or more analysis will make you profitable. Stop believing that if you just understand markets better, trading will become easier. Instead, focus on this. Can you follow your rules without deviation? Can you take losses without emotional reaction? Can you wait patiently when there are no setups? Can you execute the same way whether you're winning or losing? Can you treat your trading plan as non-negotiable? If you can answer yes to these questions, you'll probably succeed at trading even with a mediocre strategy. If you answer no to these questions, you'll probably fail even with a brilliant strategy. The bottleneck isn't your intelligence, it's your emotional discipline. And here's the good news. Emotional discipline can be developed. It's not a talent you're born with or without. It's a skill you build through practice. Through starting small, through creating systems that support discipline rather than fighting against it. But you have to be honest with yourself about where you actually are. Most traders overestimate their emotional discipline because they've never really tested it under pressure with meaningful amounts of money. If you've been trading for months or years and you're still not consistently profitable, the problem is almost certainly not your strategy. It's your execution. It's your emotional discipline. The question is, are you willing to work on the real problem? Because intelligence is easy. You can read a book and gain knowledge. Emotional discipline is hard. You have to change yourself. But it's the only thing that actually matters. Remember, smart people fail at trading every day. Disciplined people succeed. Which one do you want to be?